Merck and Co. Inc. ticker symbol MRK is currently trading at $99.05 a share. Over the last 6 months, the stock has been hammered down 23.61%. Now, this is a stock that has a strong product portfolio of blockbuster drugs, which are key drivers in the revenue. These products enjoy a strong market share and long-term potential. They also have a pipeline of innovative drugs. It has a well-diverse pipeline of drugs targeting oncology, infectious diseases, and continue R&D investment to ensure the future growth and innovation. And let's not forget about its very stable dividend payout. Currently, it has a dividend yield of 3.29%, which is very, very nice for dividend investors. So what we're going to be doing today is looking at the stock and then looking at my automated stock valuation spreadsheet to see if Merck is a buy or a sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So as I said, we'll just quickly look at the stock price. Over the last 5 years, up only 13%. It did hit its prior all-time highs and has a big sell-off since then. Can it rebound? That is the question we're going to be answering today. So let's have a look at my sheet here. If we put in the ticker Merck, which is MRK, this will load all the latest company financial data, and then we can have a deeper look. So $99 a share, 250 billion in market cap, current PE of 20.78, which, as you know, is much lower than the market average, which is currently, or the S&P 500 market average, which is currently at about 30. $4.77 in earnings per share and a beta of 0.39, meaning it is a lot less volatile than the market. Target price, analysts say it has a price of around about $129 a share, so it's trading at quite a discount. Dividend yield, as I said, 3.29%, meaning you'll get $3.26 per share. They pay around about 8.2 billion in dividend, and it is a safe dividend. In terms of the net income, 67%, and in terms of the free cash flow, 53%. If you want to get paid this dividend by before the 16th of March 2025, and you'll get paid your quarterly dividend. So here we have some of the numbers, but let's have a deeper look. Revenue all-time highs, 63.17 billion in the trailing 12 months. Good growth since the COVID year. They had a bit of a lull in 15 to 20, but they've had good revenue growth since then. Now, are they able to generate profit with that revenue? Yes, not to the extent you would like, but yeah, they are up in the trailing 12 months. A good rebound from 2023, where they were 370 million in the green, and now they are 12.15 billion. Not as high as their all-time highs in 2022. Free cash flow is at a similar story, 15.58 billion. They have increased since 23, but down from the all-time highs of 2022. Now, if we look at operating cash flow versus CapEx, CapEx has actually decreased. Operating cash flow is up, free cash flow is up, but yeah, we don't have the same numbers as 21 and 22. Shares outstanding, what are they doing? Well, they've looked like historically they've had a good buyback program. Has been flat in the last few years. So, firstly, we're going to look at the discounted free cash flow model. This is a way of valuing stocks, looking at the future free cash flows and discounting them to today's value. Currently, it's giving us a very high price. Let's just make sure. Okay, we can see why in a sec. Apologies for the coughing. $4,000 a share, that seems very high. Firstly, we'll look at the revenue estimates. 68 and 73 billion. Apologies again. I've had a bit of a cough. Yeah, 64 and 67 billion we're expecting. Oh, analysts are expecting, sorry. So that is the current year and then the next year. So I'm pretty happy with that. Net income margins, I think 17% is fair. Now, this is the reason here. Net income to free cash flow, that number is pretty out of whack because of the 2023 numbers, or 2024 numbers, sorry. Let's do an average of 90% and let's see what that gives us. $170 a share, so it's still quite high. And sorry, not quite high. This is much higher than it is at a 72% discount. If we were to just take bring that down a little bit, we'll look at an average of these numbers here. Even if we bring that down to 80%, $150 a share. Sorry, coughing quite a lot. So discounted free cash flow model says it is a buy. Reason for this, look at those free cash flow ratios, 16. That's very, very low. If you're interested in buying the sheet, please check out my Patreon. Links are in the description, but we'll talk about more that at the end. Dividend discount model, we'll quickly look at that. They have an expected growth around about 6%. Weighted average cost of capital, we'll put the discount rate about 8.5. See, $130 a share, so trading at a bit of a discount there as well. Ben Graham formula for intrinsic value. This was created by the godfather investor himself, Ben Graham. Looks at earnings per share, P of a non-growth company, AAA bond yield, corporate bond yield. What are analysts saying Merck will grow at over the next few years? If we scroll down here, 22%, or just shy of 23, 22.85. $128 a share. Grain price is over margin of safety. That's at 96, but still higher than its current price. So $128 a share. So the discount free cash flow model likes it. Dividend discount model likes it. And the Ben Graham formula for intrinsic value also likes it. Quite interesting. Finally, we'll look at the comparable company model. This is a way of looking at similar companies in similar industries and see if it is a buy or a sell. So what you can do here is you can put in the ticker of the competitors. First one we'll do Pfizer. That's a global pharmaceutical giant. Next we'll do BMY, Bristol Myers Squibb. That is has drugs, focus on oncology and immunology, and also has drugs Opdivo and Equilus. Don't know how to pronounce them, but quite similar. Oh, I typed the wrong ticker. B. And AbbVie as well, large cap pharmaceutical. Okay, we'll just switch these two around because, unfortunately, well, not really unfortunately, Bristol Myers Squibb is not profitable at the minute, so we don't have the PE. So in terms of enterprise value, AbbVie is the largest, then Merck. Revenue, Merck is the largest. 7% growth, quite high. Net income, most profitable, 20% profit margin. That is an excellent to see. Price to sales, market average is around about 3, but towards the lower end of these. Price to book, market average is 5, towards the lower as well. PEG, Peter Lynch's price to earnings growth, it is the lowest. EV to revenue, EV to EBITDA, PE, and forward PE. Let me just quickly switch this to here. We'll look at the other sheet and compare just Pfizer and AbbVie. Because unfortunately they're ruining our... But PE-wise, lowest value by quite a bit, and forward PE one of the lower values as well. So forward PE doesn't really like the stock, about $50. This takes the forward PE by the estimated, the future earnings per share. And thinks it's a bit overvalued, but about fairly valued on EV to revenue, undervalued on EV to EBITDA, and if we compare these directly, you can see it's a buy. I don't know what that's green there, we'll fix that, but $140 a share. So all of the models are very close. 130, 140, 130, and 150. So it does look like a buy according to the models. Right, guys, thanks for watching. Please check out my Patreon, links are in the description. Subscribe if you're not already, and give me a comment down below on what you think. I'll catch you guys next time.